Hello, everyone, and welcome to BFW 2401. This is the fifth part of week 6, which is bank liquidity and liquidity risk and liability risk. In this part, we will talk about the structure of the sources of liability. We are planning to raise liability, then we have to see the structure. Now we have big and the long framework of sources. Let me start with the first one. So this is the liability structure. We can have current deposit. This is where we can get a liability. And current deposit is actually, it has a high degree of withdrawal risk. It's low cost. And this is, people like me and you who deposit their money. We have also the interbearing check accounts. This is usually for businesses. This is a low degree of withdrawal risk, but it's a higher cost. And this is interest. Here we pay interest, but very little interest. So the implicit interest payments is paid on the minimum balance requirements, and explicit interest payments also is calculated. We have one problem end of this part, which I will show you how we calculate the implicit and the explicit interest for this type of accounts. And now the implicit is actually the fee, the services we provide, and the explicit is what we pay actually to the customer. And I will show it in some calculations. Now, the third one is the saving accounts. This is also either we hold current accounts or saving accounts for small depositors, and current accounts usually for businesses. History in this country, I think if you are a student or staff, they will open for your saving accounts. They don't, they open for business only current accounts. Now, historically stable, less liquid than check, but allow fund transfer and ATM use as we do usually. And the major cost is the explicit interest. They pay us 1% and less than 1%. We have the what we call the term deposit. This can be for 5 years, can be for 90 days, can be for 170 days, 280 days. It goes from 1 month to 5 years. It is actually attractive in times of decreasing interest rates because you hold it there and you get that fixed amount of interest coming. And the major cost is for the bank is the explicit interest payments, because there is no transaction in this account. There is no withdrawal, there is no services. They just give you that interest, which is the explicit one. Again, and the implicit is the one that includes services and other costs. Now we have the certificate of deposits. This is a big retail, what they call it retail. And actually it's fixed maturity, and it's up to 100,000 future value, maturity from 14 to 270 days. There is a low withdrawal. As I told you, certificate of deposit, you issue it, and it actually comes only, they can withdraw it in maturity. So if you issue it for 270 days, they will only come to you after 270 days. There is no liquidity risk. Now, when we are talking about this structure, we are talking from the perspective of the liquidity risk. The major cost, of course, the interest you are paying for this type of product of liability. We have also certificate of deposit, but we call it wholesale. This is a big amount, which is up to 1 million and above, and can be easily sold into deep secondary market. They trade this in the secondary market among investors, and that's lower cost due to high credit rating. It depends on the credit rating of the bank. If you are high credit rating, then because it depends on the market rate. So this depends on how they evaluate the bank and its credit rating. But the good thing about this, and this also, this is only you pay it in maturity, and this is customers and usually big investors and funds, they take it and they update their portfolios. And if they need to cash it or update the portfolio again, then in this case, they can sell it to another investor. So as far as the bank concerned, there is no liquidity risk in those two. Only you can give it back to them in maturity. So as you can see from liquidity risk perspective, what is the liquidity risk actually? Is the withdrawal, the sudden withdrawal. So these people will not withdraw. You know when they will withdraw. But for other people, for example, this one, the term deposit, they can, if there is a bank run, whatever, they can come anytime. Or they can, you cannot actually forecast their, withdrawal behavior. We have the interbank funds. We can borrow from the banks. And it's a very active, whether you are talking about the exchange settlement account or you can talk about the interbank market. This is a short term. It is not guarantees or collateralized. And this is between financial institutions. This is actually issued based on the market rate. And when it is based on the market rates, it keeps fluctuating, So the market rate is actually fluctuated and the cost is the short-term money market rate. You have the purchase agreement. We have talked about it. We are here talking about PNM, which is Bank Negara Malaysia, international students. What I mean is central bank. So it's the central bank. You can talk about PNM or RBA or any central bank. So this is, as I told you, it's a collateralized interbank transaction, highly liquid and flexible, but yield below market interbank rates due to collateralization. Very low. We have covered bonds, and this is maybe the last one. This is, you can issue bonds. It can issue by banks backed by the pool of assets held on the balance sheet of the bank. Safest form of bank debt, usually carry higher credit rating. Covered bond securities comes under this issue if you are talking about MBB, or you can actually issue bonds guaranteed by your assets, and it depends actually in the rating. And then I think we have the other borrowing, which is bill acceptance. Bill acceptance, you just you can accept a bill and commercial papers. You can issue bills and commercial papers, promissory notes, subordinated debt, medium term. All of those actually terms of subordinated debt, by the way, it was part of the capital, but now we deal with it as debt and liability, but it can be changed to equity, or you can stop payments. But it's still part of when we talk about liquidity, it's part of the liquidity sources. So we can talk about the papers, we can talk about the notes. This is the money market. This is usually money market. This is usually less than 1 year. This more than 1 year, long term. And this is a very, very short ones. And this is also very short ones. This is for 1 year usually. And this is according to the timing, because you only cash it in maturities. And this is not predictable if you talk about liquidity. And this is actually not predictable also. This term deposit is predictable because it's according to the time, but you can liquidate it. You can liquidate it. If you want to liquidate it, you will have to have a penalty. They will not give you the interest, or they deduct by big part of the interest. but it's not a big, a very safe source of liquidity, because the customer can come and liquidate it and withdraw at least the principal. This is very risky, as you said, because if you are talking for if the liquidity risk is the withdrawal, this is the riskiest. And those all, they can be withdrawn anytime. So this is actually everything. Now, those slides, I will not cover it anymore because it just explains what I just said. So I will just pass over this. I will talk about liquidity regulation, but because I am not testing you in liquidity and regulations and this semester, I would just say that this is what's happening in Malaysia. Basel III have their own liquidity reforms, and the deposit protection and deposit guarantee, we'll talk about it a little bit. And we will also talk about the ABS. ABS 210 is a liquidity requirement. And from all of this graph, I don't want you to worry about it, because we will talk about it and regulation when we reach to week 12. And you will do some type of pre-class activity. But for the sake of this discussion, in Australia, if you have a system of liquidity, that's fine. They will not ask you for any liquidity requirements. But if you don't have a system and you don't have a system of liquidity management, and the central bank is not happy about it, they will ask you to keep around 9% of that, 9% of your total assets as liquidity. This is ABS 210. This is all I want you to know from here. Basel liquidity have two ratios, liquidity coverage ratio and net stable ratio. This is long calculation, but still I want you just to know it from its name, that the, as an information that Basel also, which is the international regulators, have their own liquidity requirements. Now let's talk about the deposit insurance, which I think it's part of the pre-class activity. We have talked about it. Pre-class activity, what we call deposit insurance, actually is a new scheme. It was there before the financial crisis, but was extended after the financial crisis, and it's 250,000. And if you are talking about business, it comes to 1 million. And this is a long story about it, when it started and whatever. But all I want to say is deposit insurance is every bank now in Malaysia and Australia and many countries are involved in this deposit insurance. In this country, we have what we call PIDM. PIDM is agency, as a party organized by Bank Negara, established by Bank Negara, where you pay to them some type of premium, and they will guarantee your depositors up to 250,000 if there is a problem. The same thing happens in Australia. And this was the base of the whole thing about it, was to decrease bank run. And as we are talking about liquidity today and liquidity risk, and bank run is one of the liquidity problems, deposit insurance was designed and engineered for the purpose of preventing bank run and decreasing the panic and protecting the system. Because if you know you are insured, you are not going to run, and if you are not going to run, the bank will stay. So there is no contingent effect to other banks, and the system can be stable, and financial stability will be much better. This is what we called about explicit and implicit interest rate. See, the calculation of the implicit interest rate, for example, if you have a deposit, this is the cost to the customer. Deposit institution average management cost per account is, for example, 150. And the average fees and per account per annum is 100. So you serve this, because when we go now on the ATM machine, it's a service. When they send us what we call either online or hard copy of our statement of account, our account statements, that is also another. People who manage it and do it for us is also cost to the bank. So this cost, we don't see it, but it's cost to the bank when they hold the account overall. And after that, they will pay you interest, especially if you, for example, if you have a fixed deposit, if you have saving accounts or current account, they will provide all those services because of transactions, and they will give you some interest in your balance. So for them, the total is actually the implicit and explicit. Now, the average fees and per account per annum 100. So this is what they actually cost, and they charge you 100. And if your average annual size of account is 100, so in this case, your cost in this case is 150 minus 100 over. This is they don't say about, they are not talking about giving you any interest. It's just the comparison between how much they charge you, how much it costs them to hold your account. They can calculate the IRR. So they take 150 minus 100 over the 1,200. You cost them actually for 1.66%, because they are providing services for 150 and they charge you only 100. Now this is another problem. It's an interesting problem because they want you to calculate the implicit and the explicit interest. This, for example, this account is 250 per month. For the first 3 months, they don't. This is an account which held 250. This is like saving account per month for the first 3 months. This is 1 year. So the first 3 months, there was 250 in the account. There was 500 in the for the next 3 months. So the first 3 months, there was 250 average. Second 3 months was 500. And then there was 1,000 for the next 6 months. So we are talking about 1 year with all these different averages. This is a demand deposit. The account pays 5% per annum if the minimum balance is 500 or more, and pays no interest if the account falls below 500. So the depositor make an average of 50 international transactions per month and pays service fee of 1 cent for each transactions. And the cost of this transaction is 15 cents. They only charge you 1 cent. Now we want to see how much they provide you as an interest, which is explicit one, and how they pay for you, as a cost for your transactions, which we call it implicit. So if you want to calculate it, first calculate the interest, the implicit interest, which is actually you are not going to receive anything for the first 3 months because you are under 500. For the next 3 months, you will receive 5% for 3 months. This is 3 months. And then you will receive 5% for 6 months. This is half a year. Then this is the fees. So they charge you 15. It costs them 15 and they charge you only 1 cent. This is 1 cent. Should be 1 cent, not 10 cents. This is 1 cent. Okay. So now this times 50 times 12. This is the transactions. From this part to this part is the implicit. So this is 14 cents actually here. And you do it 50 times during the month and for 12 months. So that's actually equals to 30. So if you add everything now, the interest for the first 3 months is free. This is the interest for the second 3 months. This is the interest for the 6 months, and this is the implicit. So this is what they pay for discount, 61.25. If you continue now, this is another example. Suppose the minimum balance was lowered from 500 to 50, then I can do also the calculation. So I will take the 250, I will take the 500, I will take the 1,000, and then I will add the fees minus what you have to pay then I will get this amount to be 94.38. So here the internet services fees were lowered from 10 cents to 5 cents per transactions. So here now actually the fees is lowered from 5 cents. So we actually use here only 5 cents. So this is the 3 months. This is the second 3 months. This is the fourth 3 months. And this is the fees, which is 15 minus 5. Oh, sorry, let me just come back to here. This is actually 10 cents. 10 cents is just, this is 10 cents. I'm sorry, this is 10 cents. So this calculation is right. Now the next calculation is also right because this 10 cents is becoming 5 cents. And you continue the transaction, you will find it to be 94.38. This is the last, actually, end part 5. And end of the of lecture 6, which with all those parts. Thank you very much, and we'll see you in the next recording. Bye-bye.